Hey everyone, it's Daniel here from Infravest. Hope you're all doing well. I want to talk about the stock market rally and this rally that we've been seeing since June, July. If you look at the S&P 500, the S&P 500 has been up about 18%. Nasdaq has been rallying about 23 to 24%. Now, I want to debate and talk about this topic and get your views, and maybe you guys can leave a comment below and let me know what you guys think. But the stock market rally that we are seeing can probably basically give the green light for the Fed to continue to tighten and continue to raise rates as aggressively as they want to, right? And why is that? Right? When we look at the stock market, and when the Fed talks about financial conditions, they basically do talk about and they do look at the stock market. And to create tightening, and if you look at what the Fed has been doing since the start of the year and even a couple months prior to that, the Fed was prepping the markets and traders and investors that they are going to tackle this inflation and fight this inflation by raising rates aggressively, by bringing the Fed funds rate to a certain level. And a lot of the Fed members feel that the federal funds rate should be reaching between around, let's say, close to 3.5%, or maybe even close 3.5 to maybe 4%. Bullard came out today, said that he would favor a 75 basis point rate hike in September. We still have a CPI data and other data to look at in September. Who knows, he could change his mind. But right now, there are Fed members that wouldn't mind to see a 75 basis point rate hike in September. And, the whole idea before all this rate hikes was the Fed coming in, prepping the markets, talking about raising rates, tightening markets, and basically selling off bonds and doing quantitative tightening and selling off bonds off their balance sheet to create a tightening market, right? Before they even did any of that, before they did any of the balance sheet runoff, right? We know in September they're going to increase their QT, especially on the balance sheet side, and they're going to increase it by a certain amount, and that's going to start to ramp up. And down the road, they could even think about doing a complete sale of many of their bonds and selling their bonds, which would be a step higher in terms of their tightening in the markets. Now, with the stock market coming off and with the stock market coming down, right, that we've been seeing since the past couple of months, that does create tightening conditions without the Fed already not doing anything. Now, with the stock market moving up, now you are basically going against what the Fed has been saying and what the Fed has said just recently in the minutes, and what the Fed has been saying and the other Fed members have been saying today, in the past week, and so on, and even previous FOMC meeting. We have another FOMC meeting coming up in September. We have Jackson Hole event, which is a main event for all the central banks, major central banks around the world to come and meet and discuss about monetary policy. But when you see the equity markets rallying and going up, that doesn't create tightening conditions. That actually is bringing in easing conditions. And it's rallying because markets are pricing in or anticipating that either, the Fed's going to slow down on its rate hikes. It's not going to be that aggressive. We might see rate cuts next year, right? Part of the bond market is also pricing in rate cuts next year. And we're getting this massive, massive rally, especially after the recent CPI report that came in weaker than expected. And you see the equity markets, and you see Nasdaq and S&P 500 and all the equity markets move up because they're anticipating that rate hikes wouldn't be that aggressive going forward. But I think there's a disconnect between what the market is pricing in versus what the Fed is saying. And I don't think that this stock market rally is good for the markets as a whole and good for the economy going forward, because that's going to give the green light for the Fed to continue to raise rates. So the stock market rally that we're seeing could give the green light for the Federal Reserve to raise rates aggressively because they're seeing, oh, look at the stock market, it's moving up. And it's actually not, it's not horribly, down from the start of January, especially as, the markets have already rallied 18% in S&P and 24% in NASDAQ. So now that gives enough room for the Fed to raise rates aggressively, to go ahead with their plan and fight inflation because, hey, look, financial conditions are still okay. When would the Fed pivot, right? If the stock market rallies, why would the Fed pivot and start cutting rates, especially if inflation is not solved? If they're going to look at the financial conditions and say, hey, look, meme stocks are going out of going haywire. We're seeing meme stocks go haywire. We're seeing the equity markets, Nasdaq and S&P 500 continue to rally, and we still have inflation. CPI is at 8.5% year over year. The headline number. We had Fed members come out and say that there's still we're still not done with fighting inflation. Inflation, especially in the core area, is still there, and there's lots of inflation still elevated. We don't know how commodities and crude oil will play out down the road in a couple of months, so we don't want to call this as a victory. Oil prices, gasoline, commodity prices, they are very volatile, and that could pick up again heading close to the end of the year. And we did see that with the CPI report previously last year in 2021, where the summertime the CPI report did dip and then pick up again. And the Fed, and Powell said this himself, that he didn't want to mess up and call it a victory, and because this current scenario that we're seeing right now during the summer months now, the dip in the CPI, you could see the same scenario like we saw back in 2021 where it dipped in the summer months and then October, November, December, it went up. So could we see the same thing this year that sure might get a dip September time? Maybe we might be at the same level as we were last month, if or not, maybe we move up higher, or maybe by October, November, or December, we'll start to see again CPI pick up and maybe hit into the double digits. And we still have geopolitical risk. We still have Russia and Ukraine problems to deal with. That's not going to solve anytime soon. Supply chain is the biggest one. This is the biggest reason for higher inflation, right? We've been doing money printing after the great financial crisis, and inflation had a hard time bringing inflation above 2% or even at levels that we see today. This inflation level spiking up all the way to 9.1% comes because of the supply chain issues. And if that's not being solved, and if there's still tensions between China and US and Taiwan, and they've got the zero COVID policy, inflation is still going to be elevated for some time. It's not going to solve. So, in fact, a stock market rally is a green light for the Fed to continue to raise rates as they please and as they wish, and the stock market might be pricing this wrong. So a stock market rally is actually bad for the future because it might bring in more rate hikes down the road, especially because it's part of what the Fed talks about when he talks about financial conditions. Financial conditions need to tighten, meaning the stock market needs to tighten. Stock market needs to come down. Financial conditions need to ease. When they say that means they're going to cut rates and they want to see the markets move up. So if the markets are moving up already and it's easing, it's defeating the purpose of what they want to do, which is tighten the markets. If that's defeating the purpose, then guess what? They're going to come and they're going to say, sure, let's do a 75 basis point rate hike in September. Let's do more. Let's reach to 4% this year. Let's, overshoot with rate hikes this year and continue to raise rates aggressively next year. And then maybe with the Fed over tightening, then sure, this rally will probably be short-lived and you'll probably see a massive liquidation event and a massive sell-off in the equity markets. So I don't know. Let me know what you guys think. I think that, this rally in the stock market does give more room and leg room for the Fed to tighten because they need to fight inflation. They don't have a stock market mandate. They've got an inflation mandate and a jobs mandate. So if the stock market's going up, then great, fantastic. They do look at these things, but great, fantastic, because that just tells you that, okay, people are fine, the markets are doing fine, we can go ahead with continuing raising rates more aggressively. Meme stocks are going out of the roof and going crazy. Great. Looks like people have money to gamble, so hey, let's tighten more. Meme stocks and all of this jumping here and there's you won't see that in a very tight market, especially with QT. And on top of that, we've got September coming up, where we now and onwards we might hear more about the balance sheet plan that they have, the balance sheet runoff, and the talks of maybe even going in there and selling bonds to aggressively create a tightening condition. And when you look at the bond market as well, now with the yield curve, it is steepening. But when you look at the bond market, it's still not as optimistic and not rallying the same way the equity markets are. So anyways, let me know what you guys think. Leave a comment below and I'll see you guys around. Thanks. Bye.